So for my SPX credit spread from December 16th up until December 20th, I made a total of $695. So let's go ahead and dive into this concept or trading technique called vertical spread. It's an option play, so make sure you're familiar with the basic option concepts, call options and put options. Make sure you understand what those are before diving into this video. A vertical spread is a great setup to implement on market conditions when it goes sideways or little to no movement. So there's a couple of terms someone could throw at you. Besides vertical spread, people may refer to this as vertical credit spread, a bear call spread, and it's called bear call spread because you really don't want the moving ticker to touch your strike price going up. You want it to go down or go sideways. That's why people call this as a bear call spread. And also call credit spread, you can also implement a put. So people could refer to it as a vertical put spread, bull put spread, or put credit spread. When someone mentions vertical spread, this can also imply calls or puts depending on the context of the conversation. And a lot of brokers, they will have option change with vertical spread, and this will open up calls and puts for you guys to see. All right, next, let's dive into vertical spread key concept. Vertical spread allows you to collect premium upfront. It's great for a small account as it's budget friendly. Great setup for low volatility days. So this is great for days where there's no economic news or no major economic news. There are also no major earnings from stock market leader like Nvidia, Apple, so it's great for low volatilities environments. Credit spread has a high profitability of making profit. Now, of course, there's always disadvantage and advantage of every setup. The biggest disadvantage of a credit spread is the high max loss with a low max profit. So you're essentially going to risk more capital to make little profit. So here's an example. My recent trades involved me risking about $5,000 capital to gain $120 profit on the same day using 0 DTE options. DTE stands for day till expiration. So I'm buying options that expires on the same day. And this is risky because if I get it wrong, I lose the entire $5,000. If I get it right, I will only make $120. If an expert day trader were to evaluate the setup, they will say this is not worth it because there's high risk, low reward. That's fine. But if someone wants to go for high profitability, regardless of the high risk, low reward, this also makes sense. And again, it's not a play where you want to implement every day. So, it's only for certain days. It's good to have this setup in play, or at least make it part of your playbook, but just don't implement it every day. Selling call options under a normal scenario requires us to buy 100 shares. Let's use Apple, for example. You have to own 100 shares of Apple to sell one call option to collect premium of, let's say, $200. And Apple is currently going for about $254 per share. The only problem with this is you would need $25,400 for you to buy 100 shares of Apple. Some of you may have the money, some of you may not. For smaller accounts, you probably wouldn't have $25,000 in cash. A lot of your money is probably tied up on certain stocks or options. So the disadvantage of under the normal scenario is it requires a large capital size. Another way to sell Apple call option without owning 100 shares is by buying one Apple call option. So let's say Apple opens at $254. We could buy one Apple, December 27th expiration date, $285 strike price for $800. And then we'll sell Apple, December 27th expiration date, with $275 strike price for $1,000. And it's called a credit spread because if we net the two difference, we actually ended up with $200 credit in our account. Now the key is to buy the ticker. For call option, you want to buy the ticker with a strike price further out from the current market value. Same with puts. So if you're going on the put side, you want to buy the puts with a strike price further out, so that way it's actually going to cost you less to buy it. And then you want to sell a strike price closer towards the market value of Apple to collect more premium. The advantage of this strategy is the capital requirement is a lot less. We only need $1,000, and you still need money because essentially you have to calculate the difference between the two strike price. 285 minus 275 is actually 10. 10 times 100 is 1,000. So for this strategy to work, you need at least $1,000. You would also need to be approved for option level 2 on most broker accounts. Level 2 is the credit spread. You have to make sure that's approved. I don't think it's approved by default on most brokers unless if you ask them to do so, right? So this is the concept of selling call options for small accounts via credit spread. All right, now let me show you guys a recent example I've implemented this on. This setup occurred on December 19th. SPX opens at $5,912. This is the index, and that's the reason why this number is so high. Most people probably trade SPY, SPY. So SPY is 1/10 of this. So if we're going to use SPY, it would only be $591 for the market value. But I'm using SPX, which is the index of S&P 500, and that's the reason why the dollar amount is so high. During that day, I looked at the chart, and I thought, well, it's probably unlikely SPY will hit 60-20 or 60-10. So I set this up by buying SPX, December 19th expiration date, 6,020 strike price, and this cost me $788. I then sold SPX, December 19th expiration date, 6,010 strike price, collected $1,024. Netting the two numbers, I ended up with a $235 credit spread. So this is an example where I was able to make money off this. And let's go into TradingView. So for my SPX credit spread from December 16th up until December 20th, I made a total of $695. Now maybe I was just lucky this time, or there will be days where I will probably be in the red. So that's why I would not recommend this strategy every day, only on certain days when it makes sense to. So for this strategy to work, you have to look at the calendar and see if there's any news coming. So that's the first thing I check. Do we have PCE reports? Do we have initial jobless claims? And I analyze the number too to make sure that if I think the outcome is going to make the stock market goes down, then I'll do a call credit spread. If I think some economic news is going to make the market goes up, then I will likely do a put credit spread. It really comes down to the economic news. Like, let's say for next Monday, there's really no major event. So I really don't see the market going up so much or going down so much. So I feel like next Monday is another potential day for a credit spread. December 23rd. December 24th is probably better because typically on a day before the holiday, there's not many activities going on. So, I would expect low volume trading. Therefore, it wouldn't really push the market up or down in a certain direction. So I felt like Monday and Tuesday are probably good days to implement credit spreads. December 19th, SPX RSI was at 21.96, which is pretty low. Now, for this strategy, I've always checked the calendar and see what kind of news could occur on that day. And if I feel like there's no major news or I'm able to kind of anticipate outcome of economic news, then I'll set up a spread. So for this day, I don't think the market is going to go up to 6,010 index price. It's really unlikely. So that's the reason why I drew the first yellow line. This represents the sell call. And then the second yellow line above it is when I actually want to buy the call at 6,020 strike price. So these are the two yellow lines I plotted on my TradingView before I set up the trade. On December 19th, SPX opens at 5,912, which is around here. So I figure, what is the likelihood of SPX jumping from this point up until here? It's really unlikely. Could it happen? Sure. There's risk for everything, right? But it's really unlikely. So I thought there's a high profitability of me making money if I set up a spread around here, right? Because even on the previous day, the high was around 6,058. And then the next candlestick shows 6,014. Based on this, this would have to have a major news for it to bounce back up, passing this level. So that's actually the reason why I drew two yellow lines here that represents my buy call option. So that's how I set up the strategy. First, I check for any economic news, and if I'm confident there is no economic news or the economic news is going to make the market go south, then I'll go in on call options. And so that's what I did. And then throughout the day, December 19th, 11:30 a.m., the market actually went down. 12:30 p.m., went up slightly. 1:30 p.m., went up and then came back down. 2:30 p.m., up and down. So basically, December 19th had more of a snake movement. Snake movement is what I like to describe it as going sideways. A lot of people talk about bull and bear markets. This is a snake market. It went sideways. So going sideways is in your advantage by selling credit spread. It's also in your advantage by selling calls or selling put options to collect premium. Going sideways is not really helpful for those that want to flip risky options. I mean, you could probably scalp it and make some money, but it's really hard to time these small pocket areas, right? So the beauty of credit spread is as long as you don't think the market is going to move up in a certain direction, and that's how I was able to make money off credit spread. Now, there's also risk too. So let me show you guys another example here. Out of the 5 days, December 20th was the highest risk for me, where I almost ended up with a loss with this credit spread. SPX on December 20th opened at $5,842. And I thought, well, the only thing that was coming out for Friday was the PCE report. And when I read the PCE report, the actual was lower than expected. So I thought that's not really good news. And also, there's actually the federal government shutdown. Based on those two catalysts, I really didn't expect the market to move much. So I purposely drew a purple line here where I think the market is going to close at. So I basically took the low of that day, which was 5,832, and I added 100 points to the index, which was 5,932. So 5,932 is here. So this is where I thought SPX would likely end up when it closes. And I was right. It was really close to the purple line where I marked it as. Where I was wrong was SPX breached two of my legs here. So during the noontime, that's when SPX hover over my first leg and then the second leg. If it closes around here, then I would have resulted in a $5,000 loss. Because the stock market continued to go down after noontime, I was kind of lucky I dodged a bullet. So I really didn't expect SPX to break $596 strike price. And I certainly didn't expect it to hit $5,980 strike price, but it did. So lesson learned is, even though I thought the PCE report was going to drive the market lower, this was a bad setup. I shouldn't even play credit spread on that day. Or if I am going to play credit spread, then I should have put the strike prices further out. Maybe around this candlestick and collect less premium, you know. So this was risky. And also the fact that SPX was already low towards the RSI. Whenever the overall stock market hits a low RSI, there's always this high chance of it bouncing up with revenge. So that's another thing I should have factored in was the RSI. Where was the RSI at? Did it breach below 30 RSI and it continues to hover below there? If so, there's a high likelihood of this bouncing up even higher. So I should have set up my call strike price further out. Maybe the candlestick on Wednesday. So whatever the Wednesday high was, maybe set it around here. That would be a safer move. So another strategy is, besides doing a call spread, I could have set up a put spread. You know, maybe put up a put spread around this area, around here maybe. The only thing is, if I set up a put credit spread, is when the market drops, it drops like an elevator. On December 18th, if I set up some kind of put credit spread, then I would have resulted in a significant loss, because this would surely break my strike prices around here. The stock market barely goes up that much on a given day, unless if there's some kind of expected news. You know, that's the only way stock market, especially for S&P 500, that will go up by over 3%, let's say. Stock market can go down a lot on any kind of expected news and unexpected news, right? If we have some kind of terrorist attack, COVID events, any kind of news where it's not really documented, it just happened out of nowhere, that could drive the stock market to go red really fast. If someone were to set up put credit spread on unexpected news, the market can tank and it could break both of your strike prices here, resulting in significant losses. So that's why I felt like it's always safer to do call credit spread, because generally the market doesn't go up unless if there was some kind of expected news. So that's the only time when the S&P 500 can make significant price movement. In fact, I'll show you guys some queries I set up here. So Yahoo Finance doesn't offer any free historical pricing for SPX for the entire 25 years. So I will run a similar analysis for SPY, which is 1/10 of SPX. So for SPY, I have code set up to import prices from January 3rd, 2000 up until December 18th, 2024. I've instructed the codes to display all SPY historical prices that falls below -2%. There's about 181 days over the past 25 years or so that resulted in over 2% losses in a single day. Now let's do the same thing for positive greater than 2%. And there were only 138 days where SPY moved up over 2%. And let's just look at the more recent ones. And this is kind of funny. So for days where SPY actually had big movement, it looks like most of these came in our bear market. Like 2022, we had high inflation. 2020 was a COVID event. 2023, I believe, was still the bear market for the most part, and then start turning it around towards the end of 2023. And then, if you go back to less than -2, it occurs on bear market time frame 2022, but it also occur on bull market. So 2024, I would consider it a bull market because SPY is above the 200 SMA, simple moving average. April 15th, SPY had a drop of over 2%. December 18th, SPY dropped over 2.93%. So these are big movement where SPY dropped. And SPY rarely drops like this. And most days, let's look at most days for 2024, SPY barely have much movement. Which is why on most days where SPY is pretty much flat, it probably makes sense for you to implement some kind of call credit spread. Look at this. The first 5 days of January is not much movement. January 8th is where we had a spike over 1.3%. A credit spread will still work, but you would have to buy it further out. Make sure you buy and sell your strike price fully out. As likely on the 8th is when we had some kind of economic news or something that pushes it high. And let's look at the last 5 days or so. So December 18th, we had a loss here because of that FOMC. Jerome Powell said there will be less rate cuts going forward in 2025. And so that's the reason why, we had a big drop on this day. A better strategy to use for the 18th was to just go put spread or call spread. A simple one. Don't do any credit spread because FOMC can move the market. So that's another missed opportunity for me. I ended up setting a credit spread, which makes some money, but if I just went with a simple put option or call option, then I would have made a lot more. December 17th was pretty flat. 16th was flat. And, looks like throughout the month of December, on most days, it appears to be flat. And let's look at November. November was pretty flat for the most part. I was trying to see the days where we had the biggest jump. It looks like for the month of November, it was pretty flat for most days. Oh, guys, real quick, the day percentage is the difference between the opening price and the closing price. Especially if we were to implement 0 DTE, then it makes sense to calculate the opening price and closing price. By having 25 years worth of SPY, it allows me to generalize the movement. So it looks like on average, most days, SPY will not have anything over 1%. Some days it could have 1%, and on extremely rare days, it could have jump over 2% and sometime over 3%. In fact, let's put in some formulas for the same day. If we were to implement some kind of credit spread, how likely can SPY jump over 3%? Within the past 25 years, there are 43 days where SPY can move as much as 3% between the opening and closing price. And the last time we had this crazy jump was on November 30th, 2022. That was a bear market. Inflation was high. There was a lot. And then, oh wow, check this out. October 28th, 2008, there was a some percent jump. And I think this is where 2008, I think the layoff, there were a lot of, I'm not sure it was inflation, but the economy wasn't doing that well in 2008. So 2008 is where we had another historic over 7%. All right, let's see if SPY had anything over -3%. And we have 42. We have 42 days within the past 25 years where we have drops over 3%. October 9th, wow. October 9th, 2008, it resulted in an 8.9% downside. I think that was the biggest one. And then the most recent one we had was back on August 26, 2022, which is a bear market. We had a drop of over 3.3%, which is huge, right? That's a lot for the S&P 500. So my final thoughts is credit spread works great on certain ticker, especially for low volatility ticker. SPY and SPX are probably the best two candidates. SPY is probably better than SPX because it's more extremely liquid. There are more people trading SPY, the options especially. There's a lot more options going on. I'm not saying that SPX or even the ES futures can have liquid, but if someone were to just compare from a liquidity standpoint, SPY is extremely liquid. SPX and ES, they both are liquid as well. So SPY is good for small accounts because it's 1/10 of the S&P 500 index. SPX is better for tax advantages. They actually tax you 60% long term, 40% short term. So that's one of the reasons why someone would want to trade SPX and not SPY. Also, XPX is less options fee. So if someone's going to implement credit spread, you don't have to open up as many contracts. Therefore, you'll save money on fees. I'll probably create a separate video on the difference between trading SPY and SPX. But yeah, based on historical data, SPY or SPX, they are great candidates for credit spread on certain days. For certain days, also great to go long on calls or puts. So just keep this in mind, have this as one of your playbooks. I'm not saying you have to implement it every day, but the more setups you have leads you to more higher profitability depending on the environment. That's all I have. Thanks everyone for their time. Like and subscribe. Talk to you guys next time. Peace.